Welcome to 3 financial keys of the affluent. The New York Times has called private equity banking the secret of the affluent. But why? I want to talk about that today because there are 3 financial keys that the affluent all have in common, and I want to share those with you. My name is Eric Martineau, and this is my wife, Diane, and we are the owners of privateequitybanking.com. And today I want to talk to you about why the New York Times calls private equity banking the secret of the affluent. Well, you see, private equity banking provides you with guaranteed returns with zero market risk. It also provides you with liquid cash, no age restrictions, and no funding caps. It allows your money to grow tax-free. And it also provides you with protection, both from creditors, lawsuits, and the unpredictable economy that we live in. So let me ask you a couple questions. Do you have a pile of cash, but you don't know a safe place to put your money, knowing that you can get back at it anytime you want? Are taxes killing you? But the only options to store your money are taxable options and or tax-deferred investments. Either way, they're taxable. Let me ask you this one. Do you have extra cash flow, but the market's just a little too risky for you? You've lost money there before, or the banks don't pay you enough? You too can invest in guaranteed assets just like the wealthy. And I'm going to show you how. So how would you like to safely grow and protect your money? Guaranteed returns, tax-free growth, liquid cash when you want it, and protections. It is possible with the private equity banking system. You get guarantees, it's extremely safe, and it's a tax-free system. If you've gotten this far in the video, you probably have extra cash you don't know what to do with, right? You don't have confidence in the market. Like I said, you've probably already lost money there, like most of us. You're worried about the future of our economy, or you're frustrated with so much misinformation. So what I'm going to talk about in this webinar are guaranteed returns. How to acquire guaranteed assets with no risk. Protection. How to grow and protect your assets safely. I'm talking market risk, I'm talking lawsuits, etc. How to access those assets anytime you want. And, best of all, your assets will never stop growing tax-free with this private equity banking system. But you're thinking, come on, there is a lot of conflicting financial information out there. And it can be rather confusing. I understand that. And I think part of that problem are the myths that surround money. And one of those myths, in my opinion, is if your money isn't at risk, it isn't growing. We hear that all the time, right? More risk, more reward. Is that actually true? Do you really believe that's how the rich maintain or grow their money year over year? So why does that myth exist? Well, my opinion is the risk myth exists because these organizations want to put your money under management, right? But let me ask you a question. Where do these organizations put their money? And that's one of the things I want to show you. I think you're going to find this is a case of do what I say, not what I do, right? But first, one of my favorite quotes from Warren Buffett. He said, rule number 1 to financial wealth is never lose money. And rule number 2, never forget rule number 1. Which begs the question then, where do banks put their money? You know, as I said, I think they say one thing and they do another. So let me show you what I mean. Now you might be thinking, they put them in real estate, right? I mean, all of us have been to any downtown major city in the United States, and we've seen that the biggest high-rises out there belong to the banks. So if you're thinking banks put their money into real estate, you're right, they do put their money into real estate. But if I told you they have another asset that's worth, say, twice as much money to them, would you believe it? Well, they do. So where do banks put their money? Well, it's called BOLI. Have you ever heard of that term? BOLI? Bank-owned life insurance. It's so popular amongst the banks, it actually has its own term, BOLI. So where did I learn about BOLI? I'll tell you. It was during my MBA. We were talking about executive compensation packages, believe it or not. And we were told that a lot of banks provide their key executives with what's called bank-owned life insurance, or they take out policies on key executives, and those executives are then able to go in and get access or control to some of that money that's in these cash accumulation accounts that the banks own. So what I did is I thought to myself when I heard this, I thought, well, if this is true, the financial statements of all these major banks are out and open to the public at the FDIC. Any bank that is insured through the Federal Deposit Insurance Corporation, the FDIC, has to put their financial statements out there. So what I did is I went to the FDIC website and I started poking around. And I looked at the asset and liability statement, in this case for Wells Fargo. And if you go down to line 10 under assets, you're going to see that they have bank premises and real estate, right? Now, all of these figures, by the way, that I'm showing you are in the thousands. So in 2017, when I looked this up, I looked it up in 2018. So in 2018, when I looked this up, Wells Fargo had in 2017 $8.5 billion in real estate, and basically the same amount in 2018. So about $8.5 billion in real estate is what Wells Fargo had in 2017 and 18. Now, if you go a little bit further down on that asset sheet, you're going to run into life insurance assets. And when you look at those in 2017 and 18, what you'll find is that Wells Fargo had $18 billion in bank-owned life insurance in 2017 and 2018. All right, well, was that just an anomaly? This is just them, right? Nope. I decided to go look up another huge bank, Bank of America, right? Same FDIC website, same assets and liabilities, same line 10 for their real estate, and again, it's in billions, so 8.6 billion in real estate and 9.3 billion they grew in 2018. So both of these banks had about $8 to $9 billion worth of real estate. And now again, if you slide down and you go to life insurance assets, note that it does say life insurance assets. Bank of America has 21 billion in 2017 and 22 billion in 2018. Now, let me clarify what bank-owned life insurance is and is not, because you may not have heard of this. First of all, I want you to understand, bank-owned life insurance is part of the bank's Tier 1 assets. Tier 1 assets are the liquidity. See, banks have to have, as you would guess, so much money available in case there's a crisis or a run on the banks like there was in the Depression or whatever, right? They have to have so much cash available to them in a safe and guaranteed place. Sound familiar? We were just talking about that, right? That's why the banks count bank-owned life insurance as Tier 1 assets. They have access to it. It's growing, it's cash, it's liquid. It's all the things I was just saying that the rich and the affluent do in their personal lives and in their businesses. Well, so do banks. Another thing I want you to understand, that $22 billion that you see there, that Bank of America has, this is the cash surrender value. What does that mean? That means if Bob was one of their executives and he retired 5 years ago and they're still paying on the policy, they always do. Why? Because they want the death benefit, but they're paying on it, and let's say there was a crisis and they needed to get the cash out of Bob's policy. That is the cash surrender value. So that 22 billion represents what they could get if they canceled the policy today and turned it in. You with me? Okay, it is not the death benefit. Now, these banks do continue paying even after Bob has retired in this example, right? Why? Because it's part of his compensation package. That's what I was telling you. I got this in my MBA when we were talking about compensation packages, because what these executives are able to do is go back and borrow against these policies for the rest of their lives. Okay? And so it's part of the retirement package and compensation, etc. But what my point is here is that 22 billion that you see that Bank of America says they have as a Tier 1 asset, that 22 billion, the death benefit is going to be 4 to 5x bigger. So as they pay these policies and Bob gets old and passes away finally, the total value of these policies upon death benefit is probably 80 to 100 billion. Okay? Just to put into perspective how much bank-owned life insurance is out there. I want you to understand, this is not just Wells Fargo and Bank of America. This is the banking industry as a whole. Now, because they're federally insured, the U.S. Government Accounting Office, the GAO, goes in and audits these banks. Why? To make sure that they do have enough Tier 1 assets. Now, the report I'm quoting here is a decade old, but it hasn't changed. Not much. At that time, 467 US banks held over 25% of their Tier 1 assets in bank-owned life insurance. Think about that. 25% of their portfolio, their Tier 1 portfolio, is held in bank-owned life insurance. Check this one out. 58 of those 467 banks had over 40% of their Tier 1 assets in bank-owned life insurance. Let that sink in. Especially the next time you go to one of these organizations and they tell you that you need to put your assets under their management. I mean, do you really think that JP Morgan Asset Management has their money sitting out there in the risky market? No, because it can't. Because they can't have Tier 1 assets in an unsafe environment, which is exactly what Wall Street is. So all of these banks take their money and they hand it off to who? A legal reserve insurance company. That's what they're called. A legal reserve insurance company. That's who they give them to. That's where their money is. So banks, where do they have their money? With insurance companies. And why is that? I can give you one example. These banks have to have so much reserves because they're allowed to lend at 10 to 1. Guess what mutual insurance companies do? You know what they lend at? 1 to 1. $1 in, and they keep that $1. They do not make it lend out 10 times, which is what the banks do. And again, I'm not going to get into a class on banks, but you do understand that banks work with fiat currency. In other words, if you deposit $1, they're able to lend $10. Insurance companies don't do that. And that's why the banks take their own money and they put it into insurance companies, because insurance companies are safe. Much safer than the banks. That's why the banks put their money there. And by the way, if you're like me and you've watched this thing go on for a number of years, I'm sure you believe too that, government and banking seem to be just one big revolving door, right? Someone leaves it's mind-boggling. They leave a $30 or $50 million or $200 million a year salaried job with all their compensation package, and they go take a $250,000 job as secretary of something in the government, right? And that door spins, and as soon as they get through playing secretary of whatever in the banking sector for the government, they go right back to Wall Street in New York City, right? It's just a revolving door. But my point is this, and this is a question I want to ask you, right? How much of your assets come with guarantees and are protected against economic volatility that you can't control, are accessible whenever you want, right? Grow tax-free, and here's the kicker, and are in the same place the banks put their assets. And if they aren't there, why not? If it's good enough for the banks, it should be good enough for you, right? So what do I want to do here? What's my goal with this presentation? To help successful business owners that have not started warehousing their assets in guaranteed environments to do so. Or if you're a successful business owner and you have market-based products, but you're not happy with the current risky and always taxed results of those, I have a solution for you. And again, it's called private equity banking, right? So what I want to do is help you become like the banks. Do as they do, not as they say. The only way you can safely protect your money is with private equity banking. The only way you can guarantee growth on your money year after year is with private equity banking. I mean, ask that of your financial advisor. What can you guarantee me? Take you to zero? That's the only thing they can guarantee you, right? The only way you can acquire assets that never stop growing tax-free is to create generational wealth is to create private equity banking accounts. And that's what I help people do. Every financial portfolio is based on a solid foundation. I thought mine was that way when I was younger. My first foundation was real estate, and I still do believe in real estate, by the way, but I lost it all. My second one was cutting-edge stocks. So you may be asking, well, why should I pay attention to you, Eric? Well, let me tell you my story. I apologize for getting personal, but both of these failed me in my lifetime, both real estate and the stock market. And I want to explain it to you so you can understand where I'm coming from. Sidney Harris once said, history repeats itself, but in such a cunning disguise that we never detect the resemblance until the damage is done. History will repeat itself. I don't know when or where, but I know it will repeat itself. So let me explain my story, if you may. My story begins with, believe it or not, Andre Agassi. Some of you may be old enough to remember him. I was a young man. I came walking through the living room one day and the TV was on, and I saw this punk kid playing against Ivan Lendl, and I thought, oh, it must be a pro-am for this little kid. No, come to find out he was ranked, I think, third in the world at the time, just as a young teenager. Anyhow, my first job when I got out of high school was working at the Foot Locker, selling shoes. I lived in Tucson, Arizona, lived on the north side of town, where we were surrounded by a number of resorts. And a gentleman came in one day, and he wanted to buy some Andre Agassi shoes. Now, those shoes at the time cost $150. I know today a $150 tennis shoe isn't that big a deal. But when I got out of high school over 30 years ago, that was a lot of money. It was the most expensive shoe we had in the store. We didn't have Jordans at the time. We had Andre Agassis, right? So this gentleman comes in, he tries on the pair of shoes, and when he gets through, he likes the certain size. He then says to me, I want 5 of them. I'm thinking, $750 of these things? Are you crazy? I said, why do you need 5 pair? He says, oh, I'm a toe dragger, and I rip up 1 pair of shoes a week. And I'm thinking, how much tennis do you play? So I asked him that. I said, are you an instructor? He says, no, I just hang out at the El Conquistador, which is a resort. I just hang out at the El Conquistador and play tennis all day with my buddies. Now, this guy didn't look 12 years older than me, right? So I'm thinking he's 32, 33 years old at the most. And I said, how on earth do you get to hang out at a resort and play tennis all day? He says, well, I'm retired. I said, how did you retire this young? He said, real estate. And then he told me that when he was about 12, his father was a carpenter and worked for a contractor. And in the evenings, one summer, he told his son, you know what we're going to do this summer? We're going to buy an old dilapidated beat up home. We're going to fix it up. We're going to flip it, and I'll split the money with you. You're going to work all day. I'm going to teach you how to do stuff, and then I'll come back in the evenings after I get out of my real job, and I'll work with you, son. And that's what this guy did with his son. And they flipped that home, and I don't know how much they made, but then they invested that money, and they did it again, and they did it again, and they did it again. He told me by the time he was 20, he had a lot of homes in the San Diego area that were already free and clear. And now, at age 30-something, he's retired with all those homes free and clear and getting the rent. I was blown away. As soon as he left the Foot Locker, I went running down the hall to the Barnes & Noble, and I bought like 5 books on real estate and decided this is for me. Well, I had already enlisted in the Marine Corps. Even though I was still at the Foot Locker, I'd enlisted. I was waiting to go in. And so I enlisted, and I got my degree, and the Marine Corps made me an officer, and I went back to Quantico, and literally a week after Officer Candidate School was over with in Quantico, I bought my first investment property. Met my wife. She was also a Marine. We met in another officer program. We went out to San Diego together, and every time the Marine Corps moved us, we ended up buying more properties. So we ended up with properties in Virginia and California and Oregon and Utah. And by the time we got out, we had about 16 rental properties, and that's what we were going to retire on. And we had put all of them on 15-year notes, and we had paid extra every single month. So I had no liquidity. That was a big error. Anyhow, I told you my second foundation was high-tech stocks. While I was in the Marine Corps, I decided to get a master's degree in in telecommunications, and I wrote my master's thesis in asynchronous transfer mode. Doesn't matter what that is. It's basically where we were able to merge voice, video, and data information, into the same stream, same data stream, and send it down a pathway. It's evolved since then, but basically anytime you use FaceTime on your iPhone or you use a Zoom call, you're using the technology that was the basis of this. And I wrote my master's thesis in 1996. In 98, I put together the first voice, video, and data network in the world that was robust. I mean, there have been some inside of laboratories, but I put together one of the first ones. And that made me quasi-famous in a little tiny niche of telecommunications. And I had a lot of companies coming after me to get out of the Marine Corps, and so I did. And just in time to take that rocket ship ride up the NASDAQ before the dot-com exploded. Now, I was actually an MC at one of the big conferences, and so I got to know all the big players. I had a lot of telecommunications knowledge, and there was a lot of companies during that dot-com era that were going public. And so I took a bunch of our money once, and I bought stock in a company the day they went public, and I got my stock at about $15. And that night they closed at, I believe, 42 or something like that, or maybe it was 30 something, and then the next day it was 42. But they had tripled within just 2 days. And then it got up to about $68. Now my goal was to get it to 75 bucks. Don't ask me why, that was just my goal. Well, 2 months go by and I'm at my mother-in-law's farm, and I'm in her office. It's the only place that had internet, and I'm up in her office, and she comes up, and I was looking at my Schwab account, and I said to my mother-in-law, I said, hey, look, Mama, I've made $150,000 in 2 months. And she said, have you sold the stock yet? I said, no. She goes, then you haven't made $150,000. You only make that money when you sell the stock. I'm the 35-year-old vice president at a big telecom company. I was bigger than life, right? I knew what I was doing, right? You know what's coming. A month later, their quarterly returns came out, and they didn't make them. I came home that night, and I said to Diane, I said, honey, I lost the $150,000. Not only that, I lost $5,000 of the initial investment before I could sell that stock. I lost more than $150,000 in 1 day. My wife looked at me and said, our little daughter learned how to crawl up the steps today. I said, Diane, you didn't hear me. I said, we just lost $150,000 plus $5,000 of our equity. She said, no, you didn't hear me. Our little girl learned how to climb up the steps today. You know, I am a very, very lucky man that I have a wife that can put into perspective the world we live in. But at that point, I said to myself, this is wrong. I don't trust this place. If I can lose $150,000 in 1 day, this is not the place I want to play. Back to real estate. That was 2001. You know what's going to happen in the next part of the story. 2008 rolled around, and what happened to my real estate empire? I lost it too. Again, I still believe in real estate, so don't get me wrong there, but I didn't have the liquidity. I did not have a private equity banking account. I had been shoveling all my extra cash every year into those mortgages. And so even though I'd overpaid on all of my mortgages, when the crash happened in 2008, I also lost a job. And I went 9 months without a job, and I didn't have enough liquidity to keep all of my negative real estate mortgages afloat. And we lost all of our real estate too. So at that point, I decided I needed to figure out how this financial thing worked in a secure way that I wasn't going to lose everything I had worked so hard for, because that was my retirement. I like this quote by Tony Robbins. He says, the only impossible journey is the one you never begin. I began a journey in 2008 to figure out how I could invest, how I could rebuild my retirement and do it with guaranteed returns, liquid cash that was always there, tax-free growth, and protection. One of the books I read, or many of the books that I read, were written by Robert Kiyosaki. I've read all of the Rich Dad, Poor Dad series. My favorite, though, is Cash Flow Quadrant. He talks about what it is to be an employee, right? And then you move down to the self-employed category, and then you move up to the business category, and then you go over to the investor category. By the way, private equity banking, for most of us, will begin at getting out of debt as employees or self-employed. Now, obviously, there's business owners that are also needing to get out of debt. And private equity banking is the most powerful tool I have ever found to get either our businesses or ourselves out of debt, so that we can then move into the most important quadrant, which is the investor quadrant. Okay? This is what I've learned. 3 important financial keys. First, key number 1, how to avoid. So, we're finally getting to the part I wanted to talk to you about tonight. 3 important keys to financial success that I've figured out over these years. Key number 1, and I'm going to talk to you about it tonight, how to avoid the 4 biggest investment mistakes most business owners make. Key number 2, 2 primary things the affluent have present in their businesses and their lives. And key number 3, how to create lasting generational wealth as a business owner using 5 secrets of the uber rich. Back to Rich Dad, Poor Dad. Again, I liked his definition better than my MBA definition. Assets, put money in your pocket. The rich buy assets. That's another quote from him that I really liked. And The rich have money work for them. This is what is so powerful about private equity banking. You can put your money into one of these accounts and it comes with guarantees, as I've said so many times already. It comes with guarantees. You put your money into the account and you get a guaranteed interest rate on that amount. Then when you want to take that money and use it, you do not take it out of your account. You use your account as leverage, as collateral to borrow money from that same reserve insurance company. And then you take that money out. And if you do it properly, and that's what we'll talk about, the amount that you're earning in interest is greater than the amount that you're borrowing in interest. And so you've always got a positive arbitrage. And your money is always making money. And when you act like a bank and you pay it back to yourself, that bank account just continues to grow and grow and grow throughout time. Okay? That's why sometimes these private equity banking accounts are called infinite banking accounts. So the number one key is how to avoid the 4 biggest investment mistakes most business owners make. Now, I told you my experience in the stock market, right? But I was talking with a friend of mine about a year ago, and he went through the same things I did back in 2008. He told me that he had lost 60% of his portfolio in the crash. He had $1 million in mutual funds, and it had crashed down to 400,000. But what I couldn't believe is that he was still putting money into the stock market and buying more mutual funds. He was still making the same mistakes that he had made prior to 2008. So I asked him, I said, why on earth are you doing this? And he said, I don't know anything else to do. He was following the crowd. He was doing what most people do when it comes to investing, right? And these are the 4 big mistakes that investors make. First thing, you invest in a 401k, an IRA, or a qualified plan. Most of these, if not all of these plans, are tied to the stock market. That means that investors in these plans are dealing with the volatility of the market. They are also paying high fees that are hidden that they don't even know about. And that's because most of these fees don't even have to be disclosed, right? Also, money as taxes are tax deferred, which means today you don't have to pay the taxes, but you will in the future. Now, some tax advisors say, or some financial advisors say that's a good thing. I don't think so. Let me give you an example. Let's say you walk into a bank and you apply for a loan. After looking over the loan application, the banker says, we will give you all the money you want. Sounds good, right? But then he says, but we're not going to tell you what the loan terms are. You don't know when the loan is due. You don't know what the interest rate is, and you have no idea when you'll have to make your first payment or how much that payment will be. Would you take that loan? Not a chance. Why? Because you're uncertain of the future. And the major problem with these vehicles is we don't know what future tax rates are going to be. We don't know in what position we'll be in as a business owner. We don't know that we'll have the write-offs that we have today, or if those write-offs will even exist, right? Can you tell me, by the way, what you think your tax rate will be 20 or 30 years from now? You have no idea. But 89% of Americans believe that taxes are going to go up over the next 30 years. Why? Well, we've got demographics of people getting older, right? We've got Social Security, Medicaid, and other things. And we've got a war that happened in 2001 that we still have to pay for that was $6 trillion, and we've got COVID that we just spent $6 trillion on. Somebody's got to pay for those things. I can only guess that the marginal tax rate will go up. And so that is one of the big problems. A second mistake is that business owners relinquish control of their money. Business owners, when 2008 happened, a lot of people were putting money into things that they know nothing about. A lot of business owners fall into this trap. Why? Because the so-called experts have told them to diversify. We will put it into a mutual fund and diversify you. If you have money in a system that is volatile, neither you nor your advisor knows what that money is going to do. Mistake number 3, they don't know enough about their investments. You're making uneducated financial decisions. I've sat in the boardroom of some large companies as a vice president. I've listened to what goes on in those meetings. Believe me. No, I won't go there. put your money into something that you understand. I understand real estate because I've been involved in it for so many years now, right? So, like I said, even though I lost so much in real estate, I still trust in it, right? But and I invested even in, as I told you a minute ago, I invested in high tech because I understood that, and even so, I lost. But I still believe one of the big mistakes that we make is investing in things that we do not understand. We need to understand. Now, again, I'm not saying there's no risk. I've got a good chunk of our money sitting out in a company. It's a private company, and if it goes, it'll be huge. But I understand the product because I was involved with it for about 8 years. And the fourth biggest mistake that most people make is that they get distracted. The business owner has their core business, but they're out looking for the hot stock or the investment opportunity, right? And it's this distraction that causes a lack of focus off of your core business, which is your business. So your highest rate of return is your own business, right? That's where you should focus. Your highest rate of return is in your own business. That's where you need to be. Focus on your own business. Spend your time thinking about that. I guess how I would try to explain this. When you put your money into a private equity banking account, you don't have to worry about the ups and downs of the stock market for that portion of your portfolio. You might for your business, but for heaven's sakes, focus on the economy and how you're going to get your business to go through those roller coasters, not your cash that's just sitting out there. Then you don't have to focus on that for your business. You can then focus on what your business needs to be doing and not the money that you've got sitting out there in the warehouse that's unpredictable. Interestingly, Tony Robbins, in his book, Money, Master the Game, he says, and this is about page 445 for those of you that want to go look it up in your copy of his book, that his attorney told him about private equity banking and how he could make money with it. And when she explained it to him, he said as soon as he heard the word life insurance come out of her mouth, he got an aversion immediately to that, right? We've all had a slick insurance salesman try to sell us insurance. Well, this is not. And that's what his attorney said to him. She said, look, you can't buy this stuff off the shelf from a salesman with a Rolex. What we're talking about is private equity banking. And a typical whole life insurance policy is not a cash accumulation account. They are vastly different. In fact, I would argue, like she said, there's probably 1 in 1,000 life insurance agents that know how to craft a private equity banking cash accumulation account from a life insurance policy. So the way she worded it, and I like this, she said, think of this as an insurance wrapper you're buying to place around your investments. All of your deposits will be largely sheltered from tax in this insurance wrapper. That's how she explained it to Tony. He then goes on and says, private equity banking allows corporations from Walmart to Wells Fargo to park their cash in an IRS-sanctioned vehicle that allows them to grow their investments tax-free. I could ask the question, what is it that erodes wealth more than anything else? Taxes. And so that's why this is so powerful, is that your money can grow forever tax-free. Now you might be thinking, well, if this is so good, who else is doing this? Well, guess what? That's how the Rockefellers have maintained their fortunes. The Rothschilds, the Morgans, 3 generations worth, President Roosevelt, President Kennedy, and all of these corporations. In fact, if any of you have ever watched the movie about Ray Kroc, the founder of McDonald's, you'll remember that there was a scene in there where he talked about borrowing money from his private equity banking account so that he could expand the franchise. We wouldn't have McDonald's today if it wasn't for Ray Kroc's private equity banking account. All right, key number 2. What are the 2 primary things the affluent have present in their business and in their lives? 1, a predictable system that creates guaranteed growth on their money. Do you see the word risk in there? No. It's a predictable system that creates guaranteed growth on their money. A proven system that enables them to use that money throughout their life as their own bank. Why is this so important? Mental clarity, in my mind, is what it is. So your mind, when it's relaxed, when your mind is not stressed about what your portfolio is doing, it'll allow your mind to focus on your business and it'll let you produce at a higher level. It's where you make your most money and your greatest returns. So continue to focus on your business. By the way, when you have your own banking system, you can be your own bank and you can earn money. So business owners, if you go out and you get lines of credit, that can go away. No more lost opportunity costs here. You get to keep your money, but you can be your own line of credit as you need it to move forward. But again, need to look at your business specifically with you to show you real numbers and how that would work. But let's say, as an example, you're buying equipment. You're a plumber, let's say, and you have to buy a truck and plumbing supplies all the time. Well, imagine if you used to go use a line of credit and now you can use your own company. Now you can pay yourself the interest instead of the bank or a leasing company. You can capitalize on that money. You become your own bank. No more lost opportunity costs. Now, the third key is simple to understand and really amazing. How to create lasting wealth using the 5 keys of the uber rich. There are 3 things they increase and 2 things they decrease. Okay? First that they increase is control. The control, and they maintain control as much as possible of their own businesses. They also maintain control of how their businesses are set up. LLCs, S corps, etc. They do not relinquish control. When you have control, you actually hold on to more money. The first thing they decrease and continue to eliminate is risk. That is a 4-letter word, by the way. You want to reduce risk as much as possible. Or, if you're moving forward with something risky, as I said, you understand it. Okay? Another thing that the wealthy increase are their returns. And the way they do this is by maintaining control and investing in things that they understand. So again, that's more return. They also leverage. They increase their leverage, and that gives them better returns, right? The next thing that they reduce is obviously taxes. You reduce risk, you reduce taxes, you can do this by setting up the proper business entities, LLCs, S corps, etc. And they get aligned with CPAs that understand private equity banking so they can take the majority of the tax code that teaches them how to avoid paying taxes and use it to their own benefit. Because you understand, the tax code, very little of it tells you how to pay taxes. The majority of it teaches you how to avoid paying taxes. And it's built for business owners, believe me. And the last thing that the wealthy increase control and returns and lower taxes and risk is through education. They gain greater knowledge and focus on what they put their money into. And the more educated you become and read and study and mentor and seminars and symposiums, whatever it is about your business, it will have a profound impact on the money that you can earn. So I've shown you these 3 secrets. Now you know how to grow and protect the money that comes in every month. All right? Remember, private equity banking is guaranteed and it's bulletproof. It teaches you to invest in assets, and it's absolutely amazing. Remember, the wealthy play by a different set of rules. They don't throw money into the market that they can't control. They keep it where they can control it. My clients and myself, we have predictable money, right? We have liquid cash available to us. We have guaranteed returns. We have predictability, and we do have tax-free growth. And by the way, this is all created for you specifically. I can't talk about generalities here because when you get one of these banking accounts, it's created around you and your needs. And that's why I sit down with my clients and I walk through what you need to do so it's perfect for you. If you're asking yourself, how can I get a predictable system in my business and in my life that generates guaranteed growth year after year and enables me to do exactly what the banks do? All you need to do is sit down with me and we can talk about it. This is perfect for you if you're looking to do a couple things. First, you're looking to store cash safely. 2, you want to grow that cash guaranteed. 3, you want to capitalize on assets that never stop growing. And 4, you want to increase your future retirement income. So who is this for? Successful business owners that know they're good at what they do and they make 6 figures or more. 2, business owners that truly value protecting their families, their businesses, and their legacy. Okay? Working with me as a client, by the way, is not cheap, even though I don't charge you anything. But the business owners that I do work with must be committed to investing in themselves. Remember, uncommon results require uncommon commitment. What I want to find out is if there's a fit here. Knowing where you are a good fit is absolutely crucial, because I want to get all of my clients' results and work with them for the long term. This is not a short-term play. This is not a Band-Aid that you put on there and 2 months later it's over with. This is something that is a long-term investment in yourself. Again, it's generational wealth. If you want to structure it properly, your wealth from your business can carry on for many generations to come. Click below to get a free, no obligation assessment to see if we fit and to see what private equity banking can do for you and your business. My name is Eric Martineau. Private equity banking is the key to providing you with the guarantees you're looking for. Give me a call, email me, click below, set up a time, and we'll go through it. Thank you for taking your time with me.